So your credit score is one of the most important pieces to your financial health, but growing up, many people never really learn how it works. And honestly, the credit scoring system is set up in a way that can feel just confusing and unclear. Now you could choose to ignore your score, hope for the best, and probably end up with a number in the 500s or 600s, but a low credit score like that is probably going to cause you to be denied for most good credit cards, rejected for a nice apartment you want to rent, and stuck with the highest interest rates for a mortgage or a car loan that can cost you extra tens of thousands of dollars over your lifetime. Or you could follow the 5 simple steps that I've learned and organized in this video that have guided me and millions of others to getting excellent credit. Now these 5 steps are going to be in the order of most important and most actionable first, but when you put together all these steps at once, it's going to give you sort of a map to follow that'll lead you to eventually getting up to that high 800 score. So with all that said, let's get right into the video here. Make sure to tap the like button and subscribe down below to help support the channel, and maybe grab a pen and paper to take some notes along the way. But step number 1 is going to be to prioritize on-time payments. Now I think most people know that you need to pay your bills on time because there's always some sort of a punishment if you don't, like getting hit with some sort of a late fee. But what most people don't realize is how bad it could be for your credit score if you miss a payment, even just one single payment on something like a credit card or a loan. That's because payment history is actually the highest impact factor to your credit score, since it accounts for about 35% of it. And the way you can look at this factor is that for each credit account that you have, which has a monthly payment date, you basically have 12 opportunities per year to make an on-time payment. So if you have one credit card, that's 12 possible on-time payments per year. Or if you have 10 credit cards, and that's 120 times in a year when you could pay on time. And these are going to slowly accumulate over the years to show a good track record of on-time payments. Now when it comes to credit cards, typically you're going to have your payment due date fall on the same day each month. And on that payment due date, you have to make at least the minimum payment from the previous month's billing cycle in order for the payment to be considered on time. So for an easy example, let's say your next payment due date is October 21st from your previous billing cycle period from September 1st to September 30th. Now your dates will vary depending on your billing cycle, but in this example, I have to make whatever that minimum payment is by the October 21st due date, otherwise I'll be late. Now we really want to pay that full September billing cycle statement balance by that October 21st due date and not make just the minimum payment, because if we pay only the minimum, then we're going to carry that remaining statement balance and it'll start accumulating interest. So that's what I mean in my other videos when I always say you need to be paying off your credit cards on time and in full. We want to pay on time by that due date so that we have a positive impact to the big important payment history factor of our credit score, but we also want to pay in full to avoid paying interest. So hopefully that clears up the myth that carrying a balance is good for your credit, because all it really does is just cost you extra money. So with step 1 of prioritizing on-time payments, because this is the most important factor of our credit score, we never want to miss a payment, since a 100% payment history across all accounts is going to have the best effect on our score. And the more credit accounts we have, the more opportunities we have to make on-time payments, which is a good thing in the eyes of lenders, because it makes it easier for them to trust us when we have a proven history of paying back what we owe. Now back to that example, if I did forget to make that payment by the October 21st due date, all that's going to happen right away is I'll be charged a late fee of around 30 bucks or so, but the credit card issuer is not actually going to report that payment as being late to the credit bureaus until it's at least 30 days late. So if I realize that I missed that payment, I have some time to pay so it doesn't negatively affect my credit score, and then I can also explain my mistake to the credit card company and usually get that late fee waived as well. Now what I recommend is that you put some systems in place so you never risk missing a payment in the first place. So set reminders, check your accounts regularly, and even set up auto pay if you need to, because like I said, with this being step number 1, you need to make on-time payments your top priority. If you do miss a payment and it becomes more than 30 days late and shows up on your credit report, it can drop your score by as much as 100 points depending on other factors, and your score will only slowly recover as that late payment stays on your report for about 7 years. Now aside from having those systems in place to never miss a payment, as you add more and more credit accounts naturally over time, the total number of on-time payments on your credit report will grow. So because of this, if your credit is more mature, then a missed payment is not nearly as bad as someone who misses a payment within their first year or two, because their credit history is very short and very limited. Now me saying all of that is just the long informational way of saying always pay your bills on time. So honestly, step 1 is easy to follow if you're being responsible with credit, but following step 2 here is where a lot of people really boost their credit closer and closer to 800 by just making a few simple changes to the way they use their credit cards. And that step is to keep a low credit utilization. So I've talked about credit utilization in plenty of other videos before, and again, go subscribe down below if you haven't already to check out that other content. But credit utilization is the most important part of the amounts owed factor of your credit score, which accounts for about 30% of your score. Now your overall credit utilization is calculated by taking your total credit card balances and dividing that by your total credit limits. So if I had 3 cards, one with a $50 balance, one with a $100 balance, and one with a $200 balance, and then each one had a $1,000 credit limit, then that would be $350 of total balances divided by $3,000 $3,000 of total credit limits for an overall credit utilization of 11.7%. But the way the credit scoring system works is that it also takes into account each individual card's utilization. So in that same example, we would calculate each card's utilization as a $50 balance divided by a $1,000 limit for the first card, 100 divided by 1,000 for the second, and 200 divided by 1,000 for the third. So that would give us individual credit utilizations for each card of 5%, 10%, and 20% respectively. Now the general rule of thumb is that anything below 30% is considered good, so you don't want to go over 30% on any individual card's utilization or on your total combined utilization, but we don't just want to be good here, we want to be great because of course we're aiming for that high 800 credit score. So our rule is going to be to keep credit utilization below 10%, but really the lower the better. Now some people ask me whether it's better to have credit utilization in the low single digit percentages or to have it at 0%, and for me, here's how I handle it because both can be good and definitely are better than having it at 30% or above. So since I have 10 active credit card accounts on my credit report, but only use maybe 3 to 4 of them on a regular basis, the other 6 to 7 unused cards just carry a $0 balance and a 0% utilization gets reported each month. I'm not going to go out of my way to use all 10 cards each and every month to get a low utilization reported because the small benefits that would have for me is really not worth my time. So for the 3 to 4 cards that I actually do use, I just keep my utilization on those cards typically around 1 to 3%. Now sometimes if I make a larger purchase on one card where I spend more than usual and my balance gets a bit too high, then what I'll do is I'll pay down some of that balance before my statement closes so that my balance is back within that 1 to 3% utilization range. That's because credit utilization is typically only reported once per month to the credit bureaus on or right around your statement closing date, so you can think of it like picture day at school. If I know that my credit card statement closes on the 30th of this month and my balance is a little bit too high, then paying down some of that before then is going to allow my utilization snapshot to be reported as lower and look good. So to keep it simple, if I have a $1,000 limit and I have to buy something that costs $500, so that's my balance, I can prepay maybe $490 before my statement closing date, so that way my balance is only $10 and my utilization closes at 1% when it gets reported to the credit bureaus. Then I can pay off that remaining $10 balance by the payment due date so that I'm making an on-time payment as well. Now that's just an oversimplified example, but the main reason this is such an important credit score factor is because lenders want to make sure that you're being responsible with the credit that you've been given. If you're using too much of your credit relative to your limits, then that could be a signal that you're under financial stress and maybe you're over borrowing money that you just can't pay back. Now prepaying your balance is one way to keep utilization low, but another way is also to just get higher credit limits on new credit cards or to ask for credit limit increases to existing accounts. I talked about credit limit increases in another video that I'll link to down below, but basically by having higher overall credit limits in the denominator of that utilization equation, if your balances remain about the same, then your credit utilization percentage will decrease. Now next, for step number 3, this is where we really have to start factoring in time, which I think is the most important factor to getting up to an 800 level credit score. So step number 3 is going to be to grow your length of credit history. Now length of credit history actually comes in as the third most important credit score factor since it accounts for about 15%, and for this the general rule of thumb is that the longer your credit history is, the better. However, unlike the first 2 big important steps that we just went over that you can literally take action on today to improve, your length of credit history is really something that takes time and patience to get better. The most important thing you could do is get started as early as possible with credit so that your first accounts can be established and start aging, and when we look at this factor, we're really looking at it from a few different angles. So first, this is going to look at the age of your oldest account, which means that the sooner you got started and opened that account, the better. Now my first credit card was a student card that I opened back in the summer of 2016, and that account just turned 6 years old this year, but I actually made the mistake of ignoring my credit for 2.5 years after I turned 18 until I opened up that first account. So really my oldest account could have been 8.5 years old instead of 6, which would be even longer and even better for my score. Now more importantly, this length of credit history factor focuses a lot on average length of credit history, which basically takes all your credit accounts on your report, it looks at how old they are, and then averages together all those ages. So even though I have one credit card account that's 6 years old, my next oldest is just under 4 years old, and after that I have 6 or so open in the last 2 years, with 3 of those open in the past year. Now this is where you start to see some of the multiple pieces that affect your credit score moving all at once, because on one hand I have a bunch of these younger accounts that weigh down my average length of credit history to the point where it's only a little over 2 years old today, but I mean I'm still young, right? I'm still only 26, so by the time I'm in my 30s and 40s and beyond, these accounts that I have open, with a lot of them being no annual fee cards, they're just going to continue to age more and more and raise up my credit history as time goes on. So yeah, I'm sacrificing this credit score factor a bit in the short term by opening new cards and dragging down my average age, but at the same time in the short term, as long as I'm focusing my efforts on the first 2 steps with payment history and credit utilization, then my score is still going to be great in the short term, and it'll be really great in the long term as my length of credit history improves. So with step number 3, just be patient because there's not much that you can do other than wait and let time do its thing as your length of credit history grows. But get started early and make sure that you keep your oldest credit card accounts open, especially if they have no annual fees, because those are 2 very common mistakes that I see a lot of people make. Now that brings me to step number 4, which is managing new credit, because that goes right along with how that new credit can weigh down the age of your credit in the short term. Now new credit affects another 10% of your score, and the way it impacts your score is that each time you apply for a new credit card, a loan, or any other type of credit, the lender is usually going to run what's called a hard inquiry. All that means is that they're pulling your credit report to take a look at it, and they want to make sure that you're responsible enough with previous credit that you've been given. But when they do that, your credit score is going to temporarily decrease by a small amount of maybe 5 points or less. And it decreases just because when you're applying for new credit, the scoring system assumes that you needing to borrow more money is a little bit risky because maybe you really need it. So the more and more hard inquiries you have on your report, the more impact it'll have negatively to that score in the short term. Now, pretty quickly, as time goes on over the next 2 years, the impact of a hard inquiry fades as you do things like make on-time payments and keep credit utilization low on that new account. And eventually, after 2 years, each hard inquiry is going to fall off your report and no longer impact your score. Now, back to my situation, like I said, I have around 6 or so new credit accounts over the past 2 years. So those hard inquiries usually drop my score by 5 points or so right away, but then my score quickly recovers, so it's not that big of a deal. Actually, for the past few years, my credit score sort of hovered in a bit of a wide range from 750 to 800, depending on where I look. And honestly, once you get up to this range, there's really not much additional benefit to going higher because I'm already able to qualify for pretty much any credit card or the best interest rates when I need them. So right now, I'm okay with these short-term decreases to my score by having all those hard inquiries and by having new accounts way down my average age of credit, because I know that those inquiries are going to fall off and my credit age will continue to increase. So because I'm happy with my credit score and I don't need it to be sustained at 800, I'll gladly just sign up for new credit cards to get sign-up bonuses and rewards. Now, my tip with this step of managing new credit is to identify your situation and your goals for your credit score in both the short term and the long term. If you're applying for a mortgage soon and you want to get that score as close to 800 or above as possible, then maybe ease up on the hard inquiries from new credit for 6 to 12 months before buying a house. I mean, if you have all these new credit accounts showing up on your report and your age of credit is looking younger and younger, then that could affect your score and not give it enough time to recover for you to get the best interest rates on that mortgage. But if you're brand new to building credit, then for those first 2 years or so, the impact of a few hard inquiries each spread out over 6-month periods is not going to be that bad since you're building a solid base for your credit. And those hard inquiries are going to fall off quickly, and then those accounts are going to age for your credit score as it rises pretty nicely. Now that brings me to step number 5, which kind of helps to round out the journey up to an 800 credit score. And I'm including it last year because this is really more of a hands-off factor that also involves being patient and having a long-term view. And that step is to develop your credit mix. So credit mix makes up the remaining 10% of your credit score, and basically it just tells lenders that you're responsible with managing a diverse mix of credit accounts like credit cards, a car loan, mortgages, and other things like that. Now for me right now, I have 10 credit cards and an auto loan on my credit report, so my credit mix might not be as diverse just yet compared to some other people that have 1 or more mortgages, some other loans, or other types of credit. But that doesn't mean that if I'm trying to get a credit score of 800 that I'm gonna go out tomorrow and take on more debt or get a mortgage to buy a house just to help out my score. No, what I'm gonna do is just live my life and then let this final factor play out naturally. Whenever I'm ready to get a mortgage for my own personal situation, that'll be great for my credit mix as I start making payments on that each month. And similarly, I'm not gonna tell people to go out and get 10 credit cards like me, or I'm not gonna say that you have to finance a car with an auto loan if you just wanna pay for it in cash and be out of debt. You have to do what works for you, and the good news is that since credit mix is one of the lowest impact factors to your credit score, it's definitely not a top priority to get to 800. But it still matters and shouldn't be ignored, so as all the other factors play out and improve with the other steps that we talked about here, your credit mix will do the same, and the compounding effect of all these factors is gonna be what finally drives you up to that 800 credit score. Now, getting that score eventually over time is definitely achievable for anyone, but the truth is that when you're using credit cards to build your credit, there's so many mistakes you can make along the way. That's why if you're a beginner with credit cards, you need to go watch this video over here next on the 5 key lessons you have to learn, so that way you'll move up with that credit score up to 800 and not down in the other direction. But as always, thank you so much for watching, and I'll see you in the next one.